Debt consolidation explained. Is it right for you? Do you feel overwhelmed by managing multiple debts? Are you wondering if debt consolidation could be a solution for you? If so, you've come to the right place. Today, we will clearly explain how debt consolidation works, how to approach it wisely, and whether it's the right choice for your situation, without any confusing jargon. Managing multiple credit cards, medical bills, or personal loans can be overwhelming. Debt consolidation offers a way to simplify your financial situation and may even help you save money. However, it's important to understand that it's not a one-size-fits-all solution. In this video, we will explore practical steps, real-life examples, and honest insights to help you make an informed decision. Debt consolidation is a financial strategy that involves merging multiple debts into a single consolidated loan or repayment plan. This approach simplifies the debt management process by transforming several separate obligations, each with its own due date and payment terms, into one streamlined payment. Rather than juggling multiple bills, borrowers can focus on a single monthly payment, which can significantly reduce the stress associated with managing debt. The primary goals of debt consolidation include lowering interest rates, decreasing monthly payment amounts, and enhancing overall financial organization. By securing a new loan with a lower interest rate, borrowers may save money over the life of the consolidated loan, potentially reducing the total amount payable. Additionally, consolidating debts can allow for lower monthly payments, making it easier to meet financial obligations and budget effectively. Ultimately, this method aims to create a more manageable financial situation, helping individuals regain control of their finances while minimizing the risk of missed payments or default. Step 1. List all your debts. To effectively manage your debts, start with a clear and organized method. Open an Excel spreadsheet or create a free Google Sheet to maintain a detailed record of your financial obligations. Begin by creating 4 columns with headings such as debt name, balance owed, interest rate, minimum monthly payment. Next, populate the table with each of your debts. Be sure to include all your debts, such as personal loans, credit cards, student loans, and any other outstanding bills. This comprehensive list will give you a complete picture of your financial health. Once you have entered all your debts, it's important to organize them in a way that will help you strategize your repayment. You can arrange the debts from the highest balance to the lowest, or from the highest interest rate to the lowest. This organization will allow you to easily identify your most significant financial challenges and the opportunities for potential savings. By having this information laid out clearly, you can make informed decisions about how to prioritize debt payments, whether that means focusing on high-interest debts first or tackling the largest balances. This structured approach not only helps you stay organized, but also empowers you to take control of your financial future. Step 2. Select your consolidation strategy. After thoroughly assessing your financial situation, it's important to select a debt consolidation strategy that aligns best with your personal goals and circumstances. There are 2 popular options, each suited to different credit profiles and financial needs. Option A, personal loan. Best for individuals with fair to good credit, typically those with a credit score of 650 or higher. How it works. Application process. Start by applying for a debt consolidation loan through your bank, credit union, or a reputable online lender. Prepare any necessary documentation, such as proof of income, credit score, and debt details. Loan approval. If your application is approved, you will receive a lump sum that you can use to pay off existing debts. This loan often comes with a fixed interest rate, allowing you to know exactly what your monthly payments will be. Debt repayment. Use the funds from the personal loan to pay off all your outstanding debts, including credit cards and other loans. This simplifies your financial obligations into one manageable payment. Why it's beneficial. Fixed monthly payments. One of the major advantages is that you can expect consistent payments each month, which can help with budgeting and financial planning. Clear timeline to debt-free. Personal loans typically come with set repayment terms, giving you a clear timeline for when you will be debt-free. Potentially lower interest rates. Depending on your creditworthiness, you might secure a lower interest rate compared to the higher rates associated with multiple credit cards, leading to potential savings over time. Option B, balance transfer credit card. Best for individuals with good to excellent credit, typically those with a credit score of 680 or higher. How it works. Finding a card. Start by searching for a credit card that offers a 0% introductory APR for a promotional period of 12 to 18 months. Many cards provide additional benefits, such as rewards or cashback options, so very carefully review each option. Balance transfer. Once you have selected a suitable credit card, transfer your high-interest credit card balances to the new card. This action consolidates your debts into one account with a more favorable interest rate. Aggressive payments. During the promotional period, focus on making substantial payments toward the transferred balance. This proactive approach can help you pay off your debt before the interest rate reverts to a higher level. Benefits. Significant savings on interest payments. By taking advantage of the 0% introductory APR, you could save hundreds or even thousands of dollars in interest payments, allowing more of your money to go directly towards principal repayment. Single monthly payment. Consolidating multiple debts into one payment can simplify your financial routine and reduce the stress of managing multiple due dates. Warnings. Balance transfer fees. Be aware that many balance transfer offers come with fees that usually range from 3 to 5% of the amount being transferred, which can add up quickly. Ending of the promotional period. After the 0% period ends, the interest rate can increase dramatically, often to 20% or higher. It's crucial to fully understand the terms of the card to avoid unexpected charges. Risk of losing the 0% rate. It's important to stay on top of payments. A single missed payment can cancel your 0% deal, subjecting your balance to higher interest immediately. Payoff strategy. To maximize the benefits of a balance transfer, create a realistic plan to pay off the balance within the promotional period. Determine how much you need to pay each month to clear the debt before interest kicks in. Step 3. Apply and pay off your debts. Once you have been approved for your loan or credit card, it is crucial to act swiftly. Use the available funds to completely pay off all of your existing debts without exception. This means addressing every outstanding balance, whether it's from personal loans, credit card debt, or any other financial obligations you may have. Make sure to double-check that each debt is fully paid off to avoid leaving any lingering balances that could affect your credit score. Additionally, as you work to eliminate your debts, it is essential to refrain from incurring any new charges on your old credit cards. This will help you maintain a clean slate and avoid falling back into debt as you take steps toward financial stability. Consider developing a budget to manage your expenses and prevent the temptation to use credit for non-essential purchases. This disciplined approach will empower you to focus on maintaining a debt-free status moving forward. Step 4. Stick to a new payment plan. To effectively manage your new loan or credit card, it's essential to set up automatic payments. This process ensures that your payment is deducted directly from your bank account on a predetermined schedule, making it easier to handle your financial obligations without the risk of forgetting. Treat these payments as you would any other necessary monthly expense, such as rent or utilities, non-negotiable and critical to your financial health. Establishing a consistent payment schedule is key. Consider setting reminders or alerts as a backup in case of any technical issues. Missing payments can not only lead to late fees, but can also adversely affect your credit score, undoing any progress you've made in managing your finances. By adhering to this structured approach, you'll reinforce positive financial habits and maintain steady progress toward your goals. Should you use a calculator or a spreadsheet to manage your debt? Are you trying to determine how quickly you can pay off your debts and achieve financial freedom? Fortunately, you have two effective options at your disposal. Use a free online calculator. There are many reliable online calculators available, such as those from NerdWallet and Credit Karma. To use these tools, you simply need to enter key information including your total debt balances, interest rates on each debt, and your monthly payment capacity. Once you input these details, the calculator will provide you with a clear estimate of how long it will take to pay off your debts and how much interest you will ultimately save. This option is ideal for those who prefer a quick and straightforward approach, as it requires minimal effort and gives instant results. Build a simple spreadsheet. If you like to take a hands-on approach and gain a deeper understanding of your financial situation, consider creating your own debt management spreadsheet. Start by listing all your debts, including the creditor name, total balance, interest rate, and minimum monthly payment. Next, create a formula to track your remaining balances each month as you make payments. This method allows you to monitor your progress over time and see how your payments are impacting your overall debt. It also gives you control over your finances, enabling you to adjust your strategies as needed. In summary, if you value speed and convenience, an online calculator may be the best choice for you. However, if you enjoy a more tailored approach that allows you to see exactly how your financial choices are affecting your debt, building a spreadsheet could be the better option. Ultimately, the decision should be based on what feels right for you, as the main goal is to make progress toward becoming debt-free rather than striving for perfection. Pros and cons of debt consolidation. Pros 1. Simplified payments. Debt consolidation allows you to combine multiple debts into a single loan, meaning you only have to manage one monthly payment instead of juggling several. This simplification can reduce stress and make it easier to stay organized. 2. Potential interest rate reduction. When consolidating, you may have the opportunity to secure a loan with a lower interest rate than what you were paying on your existing debts. This could lead to substantial savings over time, allowing more of your payment to go toward reducing the principal balance. 3. Defined payoff timeline. Debt consolidation often comes with a fixed repayment term, providing a clear time frame for when you'll be debt-free. This can give you a sense of control and motivation to stay on track. 4. Improved budgeting and progress tracking. With just one payment to manage, it becomes easier to create a budget and monitor your progress toward becoming debt-free. You can see how much you owe and how quickly your balance is decreasing, which can be motivating. Cons 1. Loan and transfer fees. While debt consolidation can offer benefits, some options come with fees, such as loan origination fees or balance transfer fees. These costs can diminish any savings you may gain from lower interest rates, so it's important to factor them into your decision. 2. Discipline required. It's essential to exercise self-discipline after consolidating debt. Without this, you may be tempted to accumulate new debt on your credit cards or other loans, negating the benefits of consolidation and potentially worsening your financial situation. 3. Not a complete solution. Debt consolidation can help manage debt, but it is not a cure for poor financial habits. If you don't address the underlying issues causing your debt, such as overspending or lack of budgeting, your financial problems may persist. 4. Risk to credit score. If you miss payments on your new loan, your credit score could suffer even more. Consistently missing payments can lead to additional fees, damage your credit history, and make it harder to secure future loans. It's essential to stay on top of your payments to avoid these pitfalls. Detailed example walkthrough. Let's consider a practical scenario involving various debts. Imagine you have the following financial obligations. 1. Credit card A, $2,500 balance with an interest rate of 24%. 2. Credit card B, $1,200 balance with an interest rate of 19%. 3. Medical bill, $900 balance with an interest rate of 0%. This brings your total debt to $4,600. At present, your monthly minimum payments total approximately $140, which may seem manageable at first glance. However, when we analyze the situation more closely, the long-term implications become clear. With an average interest rate of around 20% across your debts, the typical scenario could see you paying off this debt over a period of 6 to 8 years. During this time, you would likely end up paying several thousands of dollars just in interest, significantly increasing the total amount needed to clear your debts. Now, consider an alternative approach, securing a personal loan of $4,600 at a lower interest rate of 9% for a duration of 3 years. Here are the key details of this option. New monthly payment, approximately $145 to $150, which is only slightly higher than your current minimum payments. Loan duration, 36 months, meaning you would be free from debt in just 3 years. By choosing this route, not only would you simplify your payments into a single monthly amount, but you would also save thousands in interest costs compared to sticking with your original debts. This method allows you to take control of your financial situation more effectively and achieve debt freedom in a much shorter time frame. Is debt consolidation right for you? Debt consolidation can be an effective financial strategy for certain individuals. It works best in the following circumstances. Multiple high-interest debts. If you are juggling several high-interest loans or credit card debts, consolidating them into a single loan with a lower interest rate can significantly reduce the overall amount of interest you pay. This can make your monthly payments more manageable. Decent or improving credit score. If your credit score is solid or on the rise, you are more likely to qualify for loans with better terms. A good credit score can help you secure lower interest rates, making debt consolidation a practical option. Commitment to a payment plan. Successfully consolidating debt requires a serious commitment to a structured payment plan. If you are determined to stick to a repayment schedule and prioritize paying off your debt, consolidation can help you achieve your financial goals. Readiness to stop accumulating new debt. If you are prepared to halt the cycle of taking on new debts and focus on paying off what you owe, this mindset is crucial to making debt consolidation work effectively. On the other hand, debt consolidation may not be necessary in these situations. Good debt management. If you are already effectively managing your debts, keeping up with payments, and monitoring your financial situation, additional consolidation efforts may be redundant. Small balances. If your debts are relatively small and you can pay them off within a few months, it might be simpler and more beneficial to handle them individually rather than going through the consolidation process. It's essential to understand that debt consolidation isn't a magic fix for financial troubles. Instead, it's a practical tool that can help simplify your financial landscape, potentially save you money on interest, and facilitate real progress toward becoming debt-free. By evaluating your personal situation and financial habits, you can determine if debt consolidation is the right choice for you. Thank you for your time. If this video has clarified your options, please give it a thumbs up and subscribe to Money Clarity Collective for more practical financial tips. Have you tried debt consolidation? We would love to hear your story. Please share your thoughts in the comments below.